And welcome if this is your first time being with us as well too. We're glad you guys are here. What do you think, Karen? You think we're ready to start?
Yeah, go
Perfect.
ahead.
Perfect. So my name is Jay Angotti. I'm a certified financial planner here at KPC Financial Solutions. And like I said earlier, but if you just joined KPC Financial Solutions, the KPC stands for Knowledge, Planning, and Confidence. And, thank you guys for joining our webinar today on tax advantage giving strategies for 2026. So allow me to introduce our speaker today. That's Karin Christ, is the CEO of KPC Financial Solutions, a CPA and former Deloitte professional. Her career spans leadership roles in corporate finance and tax planning. She now focuses her time on delivering personalized financial plans that inspire confidence in her clients. And we're glad you're here. Today, we're going to be discussing how thoughtful charitable giving can help support causes you care about while potentially reducing taxes, managing RMDs, and enhancing your overall financial plan. We'll also have a few polls throughout the presentation, so we encourage you to participate. They help make this webinar a little bit more interactive. And if you have questions along the way, feel free to submit those using that Q&A feature at the bottom, and we'll answer as many as we can or as many as time allows. So with that, thank you guys for being here. We have some great information for you today, and Karen, let's get us kicked off.
Okay, welcome everyone. Today, I just want to talk about those of you who are regular charitable givers, or maybe people who are thinking of becoming more charitable givers. Today, I just want to talk about ways that you can do this and avoid taxes at the same time. But this is not going to be a tax class. I am going to be giving an overview of 4 different ways that you can contribute to your favorite charities, but avoid giving any extra to Uncle Sam. To me, that is a win-win, okay? Anytime we do not have to pay more in taxes, or we can get a tax break above and beyond your normal itemized deductions that you may or may not know about, while we're doing something that we love to do, give to charities, but at the same time, we get to implement possibly some tax avoidance strategies, okay? And for those of you who might be taking lots of notes, God bless you. I'm a note taker too, but after this seminar, in the next day, I will be sending you a handout that highlights a lot of what I will be talking about today. And it's how to give more to the causes you love while potentially paying less in taxes. I love that part. So I'm just going to give you a quick story illustrating one of my favorite tax advantage charity strategies. And I'm just going to call it the tale of 2 families. And I'm going to be simple. I'm going to call it the Joneses and the Smiths, okay? Now, each one of them wants to give a $10,000 gift to their favorite charity, but they each did it differently. The first one did it how most people normally do. They take money out of an investment account, they put it into their bank, which is part of their normal uh, budget funding every month, and then they write a charity check. The other family is going to do one of the strategies I'm going to talk about next. And here's the difference: doing it the regular way by paying it directly out of your checkbook. Unfortunately, the Joneses got to pay a $2,000 tax bill for that if they are in a 20% tax bracket, but the other person paid zero. I definitely like zero better. So here's the thing, it's the same generosity. You're doing the same thing that you always do in giving to charities, but getting very different tax results. So here's the idea. It's about, I want you to become wiser stewards of the money that you're already deciding to give or that you have planned to give. That's why planning matters. And it's not about giving more if you want to. That's a hard issue. That's awesome. But it's about giving smarter. And here's why planning matters, because a lot of people just think charitable giving, it only affects your tax return. Okay, I can put it on a Schedule A, I can consider it an itemized deduction, but we all know that unless you are exceeding the very generous standard deductions that we now have, that charitable deduction is really not getting you anything, right? And you also need to know that depending on your tax situation, where you're at with your income, charitable planning, it can affect your taxable income. Today, I'm going to talk about how to potentially lower your taxable income with charitable giving, but not the way that you're used to thinking, which is just having a deduction on your Schedule A, an itemized deduction. But know that it can also affect your required minimum distributions. It can also affect Medicare premiums. And when I'm talking about that, I am talking about the dreaded IRMA, IRMAA. And that is when the IRS thinks that you make more money than maybe you should, and therefore you get to pay a whole lot more in Medicare premiums. Instead of the standard $203 that most people pay, you could be paying upwards of $800 or $900 a month just for your Part B Medicare. That's what IRMA is, in case you didn't know. Absolutely. This can affect your taxation on Social Security. Anytime you're adding taxable income on top of Social Security, you can push a higher portion of your Social Security into taxable, up to 85%. Yes, this can affect your capital gains taxes. I'll be talking not just about giving from charity out of IRAs, but I'll also be talking about doing it from what we call single or joint brokerage accounts. And obviously, it can affect your estate and legacy. Some of these charitable options I'm going to be going into are specifically geared to leaving a charitable legacy. But of course, hey, if you don't have to pay as much in taxes, that's more that gets left to your estate. So this is a decision. Charitable giving is a decision that can have a ripple effect across your entire retirement plan. So that's why we at KPC believe that charitable planning should not just be done in isolation. It works best when it's coordinated over your entire retirement strategy. They're pieces of a puzzle, and you want to know how those pieces are fitting together so we get an entire picture of a good, strong retirement plan, not just talk about this charitable giving in isolation. Okay, the RMD problem. RMD stands for required minimum distribution. Depending on when you are born, you are either going to face the RMD problem at age 73, or you're going to face the RMD problem at age 75. And for just very high level conversation, a required minimum distribution is a distribution from IRA and IRA type accounts that you are forced to make every year once you reach either age 73 or the age 75. You are required to withdraw this money. This money is 100% taxable. Now, you're required to withdraw it, but that doesn't mean that you're necessarily required to pay more taxes. That's what I'm going to jump into right now. This is probably my favorite tax advantaged charitable giving strategy because this one is the most widely used. It applies to far more people than the other strategies I'll be talking about later on. Charitable, it's called a qualified charitable distribution. The name means something. Qualified means you're taking it from qualified money. That's the technical word for IRA type money, or any money that you got a tax break for when you funded it. Charitable, obviously, you're giving it to charitable, and distribution because you are taking it out of that IRA. Here's the major concept. Go back to when my Jones and my Smith example in the beginning. You're giving the same gift. Your charity is still getting the exact same amount that they would have, but the benefit is you could pay less in taxes. So I want to show you quickly just how a QCD functions and how it works. So this is the way a lot of people give to charity, particularly if you are retired and you are drawing from your IRA. You've got your monthly budget. You've got, you might be pulling from an IRA in order to fund any shortfall in your monthly budget. You send that to your bank. Okay, it goes right into your bank account, and then charities are part of your budget, so you just write a check to your charity of choice. That's how a lot of people do it. But once you turn 70 and a half, mark it on your calendars if you're not there yet. If you're already at 70 and a half, you can kind of do the happy dance because you qualify. Here's how you want to process these charity checks. You want the check sent directly from your IRA to your charity, not to your bank. You don't write checks anymore or put it on your credit card. When it goes directly from your IRA to your charity, that is a qualified charitable distribution. And remember, I said any withdrawals from an IRA are 100% taxable. When you do it this way, it is 0% taxable. This is one of the most powerful tax avoidance tools that there is if you are a charitable giver. So real quick, just you have to be 70 and a half years old, and you've got to complete specific forms from your brokerage that designates that this is a qualified charitable distribution, and you're going to have to put the name of your charity, address, their EIN number. There's a little bit of paperwork, but believe me, for tax-free, it's absolutely worth it. Now, we have a lot of clients that use this. I have used this, and these are called donor advised funds. Where a donor advised fund is very powerful is it can help you offset a high income year on your taxes. And so I just want to go over a couple of examples of what might create a high income tax year for you and when a donor advised fund might be appropriate or a great strategy for you. Roth conversions. We do this a lot with our clients who are doing Roth conversions, is because a Roth conversion is 100% taxable when you do it, but we can use a donor advised fund to help offset those high income years. How about you sold a business? Maybe you exercise some stock options, or you have sold some highly appreciated stocks. Selling investment property. We come across this all the time. People that have rental properties and they decide not to keep them until they are gone. Well, guess what? Then they get the capital gains while they're living instead of having that step up in basis that eliminates it when they pass it on to children. Maybe you got a large bonus at work. Any of these could be reasons that you end up with a high income year. But what I love about a donor advised fund is you get to give today, you get the tax write-off today, but you get to decide tomorrow or in the future how you're going to disperse those funds. So what I normally like to see is you're going to take 3, 4, maybe 5 years worth of charitable giving, and you are going to fund that into a donor advised fund right up front. You get the full write-off when you fund into the DAF. So think about this. If you're just itemizing and you're not getting over that standard deduction threshold, then the charity deduction's not doing a lot for you. But a donor advised fund, by funding multiple years into that fund in 1 year, you're going to exceed that standard deduction. And now you're going to get the ability to write off that charitable donation. So this is another one of my favorite ways to avoid taxes when you are charitable giving. We have clients and we see a lot of people who are in the fortunate position of having highly appreciated stock. Maybe you inherited some stock. It's got a really low cost basis, or maybe you just work for a great company and you could buy stock options at a phenomenal price. And, we've seen instances where we're talking 1,000% plus appreciation on that stock. This is a great way to give to the charities you love, and you can wipe out the capital gain. There are a few rules on this. I'll go over them quickly again. Take notes if you want, but I'm going to send you a handout on this. That stock must be held longer than 1 year. You can only give up to 30% of your adjusted gross income. It works similar to a QCD in the fact that the stock must be directly transferred to a charity, a 501c3 that can accept the stock. But this is the beautiful part. You get to itemize the actual fair market value of the stock, not its cost basis. So you effectively wiped out the capital gain on it. Okay, so just think of it. Don't sell it yet. Think about giving it. And that would be a great tax advantage to you. And I just realized, guys, that I completely blew past one of my polls. I'm just having so much fun sharing this information. I'm going to put a quick poll out there for you. Oh, one of you guys did it for me. Thank you. Who did it? All right. All right. Okay. So let me keep going on with the appreciated stock. Again, this is a great way if you've inherited, you've got great stocks from, employee stocks. Again, don't sell it. Give it first or think about it. I'll only spend a few minutes on this because this is a more complex strategy. It's called a charitable remainder trust. This one we do not see used very often just because it's so highly specialized in what it's trying to accomplish. At a very high level, remember, names mean something. You are creating a charitable trust. When you are gone, whatever is left in this trust is going to go to the charity of your trust, of your choice. But here's the things that make this one unique. You set assets into the trust. While those assets are in the trust, it grows. But here's the benefit. You actually can pull monthly or annual income for you or your beneficiaries, either for a term of about 20 years or more, or for your lifetime. And these payments just come steadily to you. And then when you're gone, the rest goes to charity. Where I see this used most often is when people have investment real estate. Well, if they want money to live on, what are they going to do? They've got the rents coming in, but they might have a lot of equity sitting in one of these properties. Well, what are your choices? Go get, a home equity line of credit. Great. Somebody charges you interest. You sell it. You could experience some significant capital gains. Instead, by using a charitable remainder trust, you can defer those capital gains and you can start getting income for you. But again, this is income today, legacy tomorrow, and for charity. If you think this even applies to you, this is when you might want to have a direct conversation with us to go over whether this is appropriate for you or not. Okay, so which strategy do you think fits best for you? Well, if your biggest concern is the taxability of RMDs and Medicare and Social Security, or you just want tax-free IRA withdrawals, then the Qualified Charitable Distribution, QCD, might be best for you. If you're having a really high and usually high income year, then a donor advised fund might be great for you. If you own highly appreciated investments and you're a charitable giver, then doing the donation of highly appreciated stocks might be best for you. And if you need lifetime income, you want to defer taxes, and you want to leave a charitable legacy, then the charitable remainder trust might be the best tax avoidance vehicle for you. Before I move on real quick, let me, okay. You guys can throw up poll number 3, and I'm going to quick go over the 5 mistakes that we see people make all the time. How about this? Please don't wait until December. All right. You know what? A lot of custodians are very, very busy in those last few weeks of December. This is something that should be well planned out and thought of before December. Don't just stop before selling highly appreciated assets, and think about how donating them instead would work into your overall retirement plan, reducing taxes and yet giving to charities the thing that you love to do. Don't ignore the impact of IRA withdrawals on Medicare IRMA. It's a surprise you don't want to get. And don't assume that someone else is already optimizing this, like maybe your CPA is taking care of it or somebody else. We are not talking about tax preparation. We are talking about tax planning. So making charitable decisions outside of a full integrated retirement plan, you may be affecting other things that you are not aware of. Again, that's like trying to look at a puzzle when all the pieces are not in place. So we always recommend that these charitable decisions be made within the scope of a full retirement plan.
Real quick, we're going to need to launch that poll on your side.
On my side, okay,
Yeah,
can do it. Yeah, I was kind of surprised when it
Zoom's
launched.
restricting me.
Okay, hold on, folks. I'm going to launch this poll real quick for you. All right. So while you guys are answering that, I'm just going to have you also think about this checklist. You don't need to answer the questions, just think if any of these are yes. Do you regularly support your church or your favorite charities? Do you own an IRA? Do you have appreciated investments? Are you approaching retirement or in retirement? And would you like to leave a meaningful legacy? If you have answered yes to any of these, then my recommendation is you think about a retirement plan, seeing how this fits in, and looking at whether QCDs, a DAF, selling highly appreciated stocks, or a CRT might be a great vehicle for you to avoid taxes doing something you already love to do or that you're already committed to do. Okay, thank you. I'm going to end the poll. Okay. Here are the questions you should be asking an advisor. Anybody that, we would love to be your advisor. We're honored. But here's the questions to ask. Am I giving the most tax efficient way? Am I missing an opportunity? Would a QCD benefit me? Should I consider donating appreciated investments? Am I missing opportunities during high income years? But here's the most important. What strategy would work best with my overall retirement plan? I just want to kind of wrap this up with a few key takeaways. The goal is not to avoid giving, especially if it is in your heart to give. The goal is to avoid unnecessary taxes. Again, I love it when we can potentially reduce taxes, especially doing something that you are already doing or love to do. To me, it's an absolute win-win if I can give to a charity and I can avoid paying paying the IRS a cut of that. You get to support the causes you care about and leave more legacy for your family. Again, whether you want to leave a charitable legacy or whether you want to leave that to your family, hey, the less you pay in taxes, the more money for, to leave for your family. So we would love to discover together with you what is your best charitable giving strategy. And to summarize everything, this is the highlights. We want you to keep more of your money. We want you to be able to give more of your money. And we certainly want you to leave more money to your heirs or to the charities of your choice. I have one more poll I'm going to launch as we wrap this up. And Jay and Brian are looking at any of the questions that you might have. I'm going to open this up for some questions and answers, as in the time that we have remaining. But let me explain what poll 3 is. As to schedule a complimentary clarity and confidence meeting. This is just a half-hour meeting or phone call with myself, Jay, or someone on our team, just to see what your thoughts on charity and if there's a strategy that might work. Tax advantage charity meeting, we're looking specifically at what are you doing today, what's your tax situation, and how could that help. The full retirement optimization blueprint. This is the full optimized retirement plan I was talking about, where we're going to put all those pieces together, where you're going to know how long is your money going to last. Are we tax optimized? And yes, wonderful. I would love to get you on our monthly newsletter where you are going to find out these types of topics, and you'll get a heads up on our webinars, and we like to make them very informative. Okay. I am going to end this real quick and get my buttons to work so I can get to the next slide. Okay, so in wrapping this up, you're not going to need every one of these strategies that I talked about today. You just need the right one. And so I'd love you to schedule your complimentary retirement optimization blueprint. You can discover which charitable planning opportunity fits best in your unique situation. We're going to do a personalized charity giving strategy review, complimentary, an evaluation of potential opportunities to reduce taxes, not just, excuse me, not just through charitable giving, but do Roth conversions work for you? What other ways could we optimize taxes? And we look at income, Social Security, Medicare, and tax optimization. Our goal is always, though, knowledge, planning, and confidence. And we want to give you a clear action plan that's tailored to your retirement goals, to give you a plan to have the retirement that you want to have, that you've dreamed of having, and you're able to do that with confidence. That ends our webinar for today. And Jay, do we have any questions? We have a little time for some Q&A.
Yeah, here's a question that came in. Karin, how do you determine what charitable giving strategy for a client is most appropriate?
It's going to depend on how they give and what type of assets it's going to be coming from. So
Mhm.
again, if it's IRA, then we're going to look at qualified charitable donations. If it's highly appreciated stock, then we will look at the highly appreciated stock strategy. If we've got someone who is a consistent giver over years and years and years and has a high income, or we're doing Roth conversions, then we're probably going to look at a donor advised fund.
Okay. And then for someone who's interested today in learning, learning and becoming a little bit more tax efficient with their giving, what would be the best first step for them?
Call us.
There we go. So click that button or
There
write
you
it in the
go.
chat.
Yeah, just call us, schedule, either your half hour, complimentary call, or we'd love to do the retirement optimization blueprint for you, where then you can see all the components of your retirement strategy and exactly how charitable giving fits into that the best way.
Okay, we got another question here. You mentioned a rental property that has appreciated. How is that taxed if sold?
That's capital gains. So it'd be the difference between your cost basis and the sales price. And if it's been a rental property, you could potentially have depreciation recapture and a lot of other things.
Perfect. And Karen, is there any mistake that you ever see that's like a common mistake that people make when it comes to the charitable giving?
Yes, being over 70 and a half years old and writing a check. That is the biggest mistake. When you have IRA money and you're writing a check out of your personal budget, you are losing one of the most powerful tax advantage tools in the IRS books.
Perfect. Perfect. Any more questions? We'll give a few, maybe a minute here to if anyone has additional questions, we'd love to answer those. And Karen, just a question. I think it's a good thing to talk about donor advised funds.
Mm-hmm.
Um, we often hear about those. What do you think they're best suited for? What situation?
I use it most frequently for Roth conversions. I think it's beautiful as an offset to the taxability of Roth conversions. But I also think it is a great way to so a DAF earns income inside of itself, right? So think of it this way. If you have investments that are making money in the stock market or high yield savings accounts, and that money is earmarked for, say, contributions maybe a year or 2 years from now, you realize you're paying taxes on that interest income, you're potentially paying taxes on that capital gains. But when you take that money and you put it into a DAF, that DAF is earning money and it will never be taxed. I love the control that you have with a donor advised fund. You're funding it, right, with 3 to 4 years worth of money, but you have absolute and complete control over when you disperse those monies to exactly what charities that you want to.
Yeah, and just to add on to that too, a lot of people think you can just put cash in it. But as Karen, you said, you can donate appreciated stock. You can donate
Mm-hmm.
items. I've heard of boats being donated to a donor advised fund. Um, so it is kind of a large opportunity. If
Yes.
there are some assets that you want to gift to it, that is possible. Um, I don't see any more questions coming up in the chat. Um, but we thank everyone. Hope you guys enjoyed the presentation today. Like Karen said, she's going to be sending a follow-up to you so you kind of have the bullet notes and get that knowledge from this. And look, we'd love to hear from you. We'd love to meet with you. If you are a charitable giver, and these are some of the first times that you're hearing these strategies, please give us a call because, as Karen mentioned, these can be worked into a financial plan to make it stronger, to not only give more, but also pay less taxes to the IRS.
Which is always a great goal. So thank you everyone for joining us today.
Thank you.